Benchmarks, Practical Applications, Return. My name is Kevin Webb with Piper Sandler, and I'll be your presenter. Before we jump into the meat of the presentation, I wanted to make a note about where it fits in the scheme of things. When I think about the presentations that I attend, or in this case, the one that I'm giving, I like to think about, well, where does it fit? What I've done here in this Venn diagram is to take the practice of portfolio management and divide it into three spheres: philosophy, strategy, and tactics. Philosophy is just your investment philosophy. How do you define risk? How do you find return? How do you incorporate investor behavior? How do you think about the future? A strategy is just a plan of action or policy designed to achieve one or more goals. For example, demonstrate good stewardship via suitability benchmark. And tactics are the resources, skills, and methods used to achieve the goal of a strategy. The difference between a strategy and a tactic is that strategy is done above the shoulders and tactics are done below the shoulders. The goal of all of this is to, of course, try to achieve sleep-adjusted returns. Now, this presentation on benchmarks, a practical application dealing with return, is going to incorporate and be at the intersection of all three of these spheres. So what are we going to discuss in today's presentation? Well, first we're going to look at some assumptions and definitions. And then after that, we're going to look at several different facets of return. The first one being forecasting and how our understanding and others' understanding of the role the future plays and how that understanding of the future affects the judgments levied against the portfolio in the present about decisions that were made in the past. And then we're going to look at two different types of returns that get sometimes used as if they were the same thing, but in fact they're not, and each plays its own role. We're going to look at book yield and total return. Then we're going to turn to gains and losses, which will tie into how we've come to understand the role of forecasting and whether we're using book yield or total return. And that will wrap up about the understanding of the return on the portfolio, and then we'll close the entire presentation out with, well, what type of return should be used as the benchmark to compare the return on the portfolio to. And that's going to be an idea that I have titled Weighted Equivalent Bond Benchmarks. So first things first, let's look at some assumptions and some definitions. It's always good to define our terms before we use them, because one of the problems we can run into in logic, this is called the problem of equivocation, is that we use the same word in different sentences and it means different things, and it can be confusing. For example, I could say, I love my dog, I love pizza, I love my mother, and I love my wife. Well, I used love in all four of those sentences, but I mean something different by it in all four of those scenarios. So we want to make sure that we define our terms clearly before we use them. Because what we want to do when we define terms is we want to gain knowledge and wisdom. Now, knowledge, using this example here, is knowing that a tomato is a fruit, but wisdom is not putting it in the fruit salad. So we want to define our terms, know what they are, and we want to be smart about how we use them. The first term I want to define is risk. Risk just means more things can happen than will happen. Not all of them are bad. If all of them were bad, no one would take risk. And now let's define return, which is the point of this presentation. But why do we even use return at all? Why don't we just quote dollars, for example? Well, a rate of return is the gain received from an investment over a period of time expressed as a percentage. It's a ratio that relates how much we gained versus how much was risked. And there's a reason that we use returns and we don't quote dollars. One, a rate of return can concentrate a lot of information into a single statistic. And with that single statistic, it's easier and faster for investors to analyze, for example, proportions over absolute numbers, which you'd be doing in dollars. And returns are comparable even if the underlying figures are not. Whether it's in dollars or yen or it's bonds or stocks or commodities, you can compare a rate of return. And then those returns can be calculated over different time periods, and those time periods compared to one another. For example, this year's return versus last year's return. And the interpretation of return is just intuitive. It's a value that reconciles the beginning investment value to the ending value over a time period that we're measuring. Return is a ratio that relates how much was gained given how much was risked. And when we think about risk and return, we want to remember that at the core of the universe, where everything is connected, they are in fact related. You do not get more of one without the other. One of my favorite analogies for this comes out of one of my favorite books by one of my favorite authors, Peter Bernstein. And the title of the book is Against the Gods, A Remarkable Story of Risk, where he talks about the historical development of the idea of risk from the Greeks through the Renaissance, all the way up to Markowitz's groundbreaking dissertation on modern portfolio theory. But he opens this book with a quote from an obituary that appeared in the New York Times for Arthur Rudolph, who was one of the scientists who developed the Saturn V rocket. And Rudolph said this. He said, "You want a valve that doesn't leak, and you try everything possible to develop one. But the real world provides you with a leaky valve. You have to determine how much leaking you can tolerate." And that's how risk and return are related, and we don't want to forget that. And we want to define the word benchmark, which is simple. A benchmark actually historically just comes from a surveyor's mark on a permanent object of predetermined position and elevation, and just used as a reference point. But for our working definition, we're going to use and define benchmark as a standard by which something can be measured or judged. Because a benchmark can help set expectations. And who doesn't like beating expectations? In this presentation, we're going to be looking at, practically speaking, how should we calculate the return on the portfolio, and then what should we benchmark that return against. But in general, when we think about benchmarking, we should think about viewing it through the lens of prudence. Now, many older investment policies had the prudent person language, which is investments shall be made with judgment and care under circumstances then prevailing, which persons of prudence, discretion, and intelligence exercise in the management of their own affairs, and not for speculation. And prudent person focused on each individual investment. The newer language that appears in most investment policies now is the prudent investor language. And it's much like the prudent person, except that it looks at the overall risk-reward profile of the entire portfolio and not an individual investment. And that lens of prudence that we use to view things should be used to read the investment policy section on general objectives. Now, this is the GFOA sample investment policy, and most public fund portfolios are managed with an investment policy that reads similarly to this. And this section has the three objectives in order of priority: safety, where safety is just the goal to be mitigating, not eliminating, but mitigating credit risk and interest rate risk; where liquidity means not bid offer spread, but to remain sufficiently liquid so we're not having to sell bonds to pay obligations; and then the focus of this talk, return, where the portfolio should earn a market rate of return through budgetary and economic cycles. Now, if your investment policy has that language for return in it, kudos to you. If it doesn't, it might be something you want to consider changing. Stay tuned, more on why that would be later. Now, while this presentation is on return, when we think about the whole portfolio and we think about that section on general objectives of safety, liquidity, and income, and we want to be viewing that through the lens of prudence, we want to benchmark the whole portfolio against suitability. Now, I love a great visualization, and I have an entire presentation for which CDAC has a webinar of one we did a couple of years ago on the core concepts of benchmarking and how I arrived at this suitability benchmark visualization. But for the purposes of this presentation, I wanted to show that when we lay it out visually, we've laid it out in order of priority. Now, the investment policy says safety first, which is mitigating interest rate risk and credit risk, which appears here. But I start off with liquidity first, which is the second objective. You want to ensure that you always have enough cash where you're not having to sell a bond to pay an obligation. I actually believe in practice Pragmatically speaking, that's more important, and so we put the primary, secondary, and the total liquidity here. But for this presentation, we're going to focus on these two things here: the portfolio return and then the benchmark that we're going to be comparing it to. So let's look at forecasting as a facet of understanding return. Forecasting is just really our understanding that the role that the future plays, and especially the role that the future plays when judgments are levied against the public fund portfolio manager in the present about decisions that were made in the past. Those decisions that were made in the past that we're being judged on today about, in fact, were nothing more in the past other than unknown future events. And it really revolves around economic forecasting. Now, I love this cartoon with the economic forecaster and all his computer equipment and charts, and in the end, he just ends up flipping a coin. But that understanding of the role that the simple flip of a coin can play can help clarify how unfair judgments that are made against the public fund portfolio manager in the present about those decisions that were made in the past can be. So we use two terms, we use them interchangeably. You know, the problem with equivocation is using two different words that actually mean the same thing. Now, there's technically a difference between prediction and forecast. Prediction has more of the soothsayer and carnival barker, and forecast has more analytical overtones to it, but I'm going to use those terms in this presentation interchangeably. So, in thinking about predictions and forecasts, when that member of the public or city council or the board comes to you and asks why the portfolio is not earning X and LAIF or whatever investment vehicle they want to compare it to is earning more than the portfolio, it's good to have a few examples at hand of experts who got it wrong. And not just an example of experts who got it slightly wrong, but really got it wrong. Because when you're asked about why is the portfolio not yielding XYZ, what they really mean to say is, why did you not know in all those past decisions that you made to make investments that I would show up today, of all days, and ask you about it and arrange the portfolio such that it could be greater than a number it would be virtually impossible for you to know. Not only virtually impossible for you to know, but if you had known it, you were, out of the kindness of your heart, going to stay employed at our public entity and share that information with us. So just putting aside all that, have a few good examples on hand of people that got it wrong. And I'm just going to give you a few. The first one here is Franklin Raines, who was CEO of Fannie Mae. On June 10, 2004, he predicted, whichever term you'd like to use, that these subprime assets are so riskless that their capital for holding them should be under 2%. And then if that one doesn't hold, then one of my favorites, and a really bright man and a great economist by anybody's standards, Ben Bernanke, at the time, on January 10, 2008, was the chairman of the Federal Reserve, said that the Federal Reserve is currently not forecasting a recession. Now, both of these men, and there's many other examples, and I have a presentation I do where I do a little more fun on this. You can Google it and find it, and done it for CDAC and for others, called Lies, Damn Lies, and Economic Forecast. There's many more examples there, but these two examples, or others like them, should suffice to provide you with some ammunition on how unreasonable it would be to expect the public fund portfolio manager to be able to arrange the portfolio's return and income and yield such that it could beat some number you couldn't have possibly known in the future, so that you could have it higher than that number to please whoever was asking. In addition to having a few good examples on hand of experts who got the predictions just drastically wrong, matter of fact, experts that you would have expect should have known better, it's good to have an understanding, a philosophical understanding of, well, why is all this going wrong to begin with? Let's say someone did get it right. Let's say I showed up, or some other expert on Wall Street showed up at your doorstep and could prove through newspaper articles and television appearances that they had gotten a prediction on the 2-year Treasury correct 4 quarters in a row. How could you think about how to judge them? Well, it involves, and I referred to this in that cartoon with the economist flipping the coin on one of the previous slides, on how you think about randomness. In fact, use a coin. Now, another favorite book of mine called Fooled by Randomness by Nassim Taleb, he talks about that if you generated a long series of coin flips, the odds of each flip, if it's a fair coin, would be heads or tails. But if the series is long enough, you're going to get a run of 8 tails or 8 heads in a row, perhaps even 10. Even though you know the odds of any particular coin flip landing heads or tails is 50-50. One of the things I've done, and I've created this spreadsheet, and it's available to download through CDAC, and all it does is it takes one of my favorite examples, and one of my favorite economic forecasting surveys is done by the Wall Street Journal. They've done it for 30 plus years. They take a survey of 75 to 100 economists in the public and private sector, and then ask them their forecast for June and December for several years out across 5 or 6 economic variables. And what I did in this spreadsheet is I said, well, let's just say I had, in each of these simulations, and I ran, this spreadsheet runs about 100 of them, 75 economists. And their probability of getting whatever variable correct in their forecast was 50-50. Let's just say it's a coin flip. I guess it was going to be higher or lower. And then I just created a random number generator that flipped heads or tails. And I was curious, just if it was random chance alone on whether they got these predictions right, how many in each of these simulations, where each simulation consists of these 75 economists and forecasters, could I expect just from random chance alone to have gotten it right 4 quarters in a row? And it turns out, you can run this over and over, but on average, you're going to have about 4 or 5 that would just on random chance alone flip a coin that's heads or tails 4 times in a row. Now, why is that important? Well, when you think about the odds of 6 heads in a row if you flipped a coin 200 times. Now, I get this particular example. There's a professor at Georgia Tech, and he demonstrates our lack of understanding to his math class using the coin flip as well. But he has the students come in, and he says, listen, I want you to either do it for real or make it up, but go back this evening and record the results of either you're actually doing it or making it up, flipping a coin 200 times. And then when all of you come back in the morning, I'll be able to, with almost uncanny accuracy, tell you which of you lied and which one of you really did it. And that's because we misunderstand randomness. The people who make it up think random means uniform. They record heads, tails, heads, heads, tails, tails, but very few of them would put 6 heads in a row. But if he goes through and he looks at those papers and he sees a recording of 6 heads or tails in a row, there's a high odds that that person actually really flipped a coin 200 times in a row. Those that don't, odds are they didn't do it. And why is that important to understand the nature of randomness? Well, I started off giving an example of some experts who got some predictions wrong that they should have, if they really did know, should have gotten right. It's in their areas of expertise, from Raines with the subprime mortgages to Ben Bernanke and claiming we weren't in a recession when we already were in one. And then I asked the question, well, let's say the reverse. Let's say someone came to you and you could demonstrate that they got it right 4 times in a row, and they had all the evidence from newspaper articles and television appearances to demonstrate that. What the coin flipping does is provide a framework for thinking about how to understand all of these claims to future knowledge. So when I show up at your doorstep and I have that evidence that I got all those predictions right 4 times in a row, the question you should ask me, and ask every one of those people, from the economist to the broker to the money manager to the advisor, that is trading on their claim of expertise by how good they've done this last year and how they beat all these indexes, is, let's say you did that. How could you demonstrate to me that the skill you're claiming is nothing other than randomness? And the answer is, they can't. In fact, Charles Ellis, in another really good book on investment policy called Winning the Loser's Game, opens the book up with the idea and the simple fact that if someone did have that skill set where it wasn't random chance, you would have to have so many observations of them doing that to be able to be sure that it was skill and not random chance, that by the time you had gotten enough observations to feel comfortable that that was the case, your advantage, your time frame and ability to take advantage of their skill would have passed you by. So one of the other things I do, and this is another spreadsheet where we take all those forecasts from the Wall Street Journal going back 20 plus years, and then we rank them. And we rank them on how well they did forecasting which organization got Fed funds right. Those are the ones highlighted in green here, or the 10-year Treasury, or the unemployment rate, or CPI, or GDP, or whatever. We have these 5 variables here, economic variables. The ones highlighted in green were number 1, and if there's multiple, that means they were tied. Number 1 for that variable. And then we just take how they ranked and average those ranks, just a simple average. And whoever had the lowest number of all their ranks was the best one. And so what we did here is we're looking at the overall rank from the Wall Street Journal survey in December 2011 for forecasting these variables just 6 months out to June 2012. And you can see there's Moody's Investor Service, University of Central Florida, so on and so forth, going all the way down. Now, if we just move forward to looking at the forecast from that same December 2011 survey now for a year out to December 2012, the rankings change up. And this is another property of the whole enterprise of forecasting. And that is, whoever showed up on your CNBC or your Bloomberg TV as the forecaster of the year is likely to not be there next year. So the experts get it wrong. And even if they could get it right, how could you differentiate their claimed expertise to be anything other than random chance? You couldn't. You would need more data to do that than it would be practical for you to take advantage of any skill if it did exist. And then in reality, when we do rank them and we say who's the best, that's always changing. They say that a picture is worth 1,000 words, and one of my favorite pictures, charts, visualizations, if you will, that demonstrates the hazard, if you will, in following the forecasters and using them as your guide, and also demonstrates why their value is not in their forecast, it's in their framework that provided the forecast, is what I call my visual accuracy charts. Now I'm just going to show this here for Fed funds and the 10-year Treasury. More of those charts exist in the Lies Damn Lies economic forecasting spreadsheet. But what I have here is the dark black line with the black circles is the actual variable for this slide. It's the Fed funds rate. And then each of the colored dashed lines from the light blue to the orange is the median forecast from each of the surveys in the Wall Street Journal from December 2011 to December 2015. So we have 5 years of surveys there. And the extent that those dashed colored lines differ from the solid black line is, well, my term for it is near miss. You can see that they're not very accurate over the long run, that they get it wrong, that the value in the forecasts is not in their accuracy. It's in that they will provide you a framework for thinking about why your portfolio is valued the way it is based on market expectations, and that will also influence why you're seeing the offerings you're seeing. The value in the forecasts are not that they're going to be accurate. Here's the 10-year Treasury, even demonstrates it more. Why do we bother forecasting the 10-year Treasury? Well, mortgages in the United States trade off of it. So in the Wall Street Journal, they do Fed funds in the 10-year Treasury. You can see here that it exists as huge deviations for each of these median forecasts from each of those years in December 2011 to 2015 versus the actual 10-year Treasury. And it's not a surprise why. Think of these forecasts. The Wall Street Journal for 30 years has had an intern or some employee call these professional economists up and ask them to give them for free their forecast that your forecast on each of these economic variables that you're going to share with your readers. That tells you that the value is not in the forecast. If they really believed it and they were going to trade off it, they would never share it with us. Just like you could share with that board member or council member that I started this portion of the forecasting part of the return presentation on, that shows up and asks you why are you different and under some number. You could just remind them that if you'd actually known what that number was going to be, that they wouldn't be talking to you right now. That you'd be on your own private island with your social security number expunged from the record, your own private Starbucks, and no one would ever know your name. But to really drive the point home, I want to round out this portion of the return presentation for benchmarking and this forecasting portion of it with one of my favorite graphs of one of my favorite groups of forecasters. Now this group is the FOMC. Now the FOMC differs from those economists we see in the Wall Street Journal Economic Forecasting Survey in that those economists in that survey don't actually control any of the variables that they're forecasting. Now our friends that sit on the FOMC in this infamous or famous dot plot, if you will, actually control the Fed funds rate. And this dot plot shows what their expectations were on December 14, 2016 for the Fed funds rate for that current year, the next year, and into the future. And you can see that in 2019, the median forecast was for a Fed funds rate that was somewhere close to 3%. Now this is a group of people, and all the dot plots, many of them look like this, who are making a forecast about a variable that they themselves control. And you're being asked why the portfolio yield is not at some level or below some other yield of some other investment vehicle? It's the wrong question. The question that they should be asking is, what was the next best alternative that we could have had other than the return that we're earning? But to do that, we need to understand, in fact, what is the return we're earning? And there's two predominant methods for calculating return, and they get used interchangeably sometimes, but they mean different things. And one is book yield, and the other is total return. And we're going to discuss those in this next section. But before I move to that, I promised you, if you didn't have in your investment policy the language of earning a market rate of return through budgetary and economic cycles in there, that you might want to consider adding it. And the reason is that to sum up just the entire last section where we showed experts who got it wrong, we showed that even if they got it right, how could you ever differentiate that from random chance? And then even when we look at the experts and rank them according to who's best, they're always changing. And then when we looked at a specific group of experts, the FOMC, who in fact control the very variable that they're forecasting, they can't even get it right. Barring all that, a summation answer, if you have that section in your investment policy on earning a market rate of return through budgetary and economic cycles, you could just point out that that's not what your investment policy mandates that you do. It doesn't mandate that you beat anything. As a matter of fact, it has wisdom in those words, that the economy, just like the budget of your public entity, is going to have ups and downs, and your job is to earn a market rate of return through those cycles. But first, what kind of return, when we talk about what the portfolio is earning, do we mean? So we started off our definition section under assumptions and definitions with a couple of definitions, one of them being return. And a simple definition of return is that it's just a ratio that relates how much was gained versus how much was risked. And one of the standard return calculations is total return. And it does that, relates how much was earned versus how much was risked over a time period, using the following calculation. So if you just look at this down here, total return in the numerator is just the ending market value minus the beginning, so any gain loss, plus any cash flows that occurred over the horizon, all that, whether it's a positive or negative number, divided by the beginning market value. And like most calculations and most definitions, it has some assumptions in it. And total return assumes that, I highlighted it in this section here, it assumes that the investor is indifferent between the source of return. Total return assumes that if this is a gain, that means as much to you as the cash flow over the period that we're analyzing. Now, that may be true for pension funds, but I don't think it's true for public funds that are general funds. I don't think that the gain from a price appreciation means as much to most public fund managers as the cash flow or income that is earned over that horizon. The reason is that if I could poll all of you and we were together, which hopefully we'll be doing these presentations in person in the near future, and I asked all of you, do you define yourself as a trader or an investor? Most of you, I think, would say investor. A trader is someone who, when they buy a security, has the intention of selling it before maturity, in this case with bonds, to profit from a price gain, where an investor seeks to earn an above market income and usually hold that investment unless some circumstances like downgrading credit or a rebalancing opportunity presents itself to them, and hold that investment to maturity. And so for most public funds, I think income is a much higher weight in that calculation. But total return assumes that they're equally meaningful. And for most public fund investors, that's just not true. Total return is just one calculation, one return ratio, if you will, that relates how much was gained versus how much was risked over some time period. But it isn't the best one for a public fund general fund. I think that better calculation and better return measure is yield. But before I get to why, I want to address one of the arguments that those who advocate total return be used also as the predominant return measure for general funds make and levy against yield. And I'm going to let these authors of this article from the Journal of Economics and Finance Education state it for me. And I highlighted it here from this portion, but basically the argument goes like this. Unfortunately, yield makes an assumption. Due to the fact that yield or yield to maturity will equal the rate of return realized over the life of the bond if all coupons are reinvested into interest rate equal to the bond's yield to maturity, makes it where yield to maturity or yield isn't a good measure. In other words, you're never going to earn it because you have to reinvest those cash flows at the yield to maturity to realize the yield to maturity. Well, that is simply just not true. So why isn't it true? Well, let's take a step back real quick. And what do we mean when we say yield. What's the definition of yield? Well, we have a lot of different terms we use in place of the word yield. This is another problem of equivocation. We use a lot of different words and they all mean the same thing. When we're looking at variables and equations, it could be I. We could use the word yield. We could use internal rate of return. We could use required rate of return. But they all mean the same thing. And so what I'm going to do here is take from the Dictionary of Finance and Investment Terms their definition of yield and show how it's defined, and in their very definition, how they don't understand what they just wrote. They actually make a mistake. But let's just read it real quick. So here it is right here. Yield is nothing more than the discount rate at which the present value of all future payments would equal the present price of the bond, also known as internal rate of return. Now here's where they make the mistake. It is implicitly assumed that the coupons are reinvested at the yield to maturity. But notice that that's not actually part of this part of the definition. It just says it's the discount rate at which the present value of all future payments would equal the present price of the bond. Now we're going to take a minute and we're going to break down the calculation of the cash flows on a 5-year treasury in this example and demonstrate why that assumption that's often levied by advocates of total return for general fund portfolio managers that they use against yield being a better measure of return, that ratio that relates how much was gained versus how much was risked, and why in the dictionary definition on the last page, that last sentence is actually not true. And I want to use this spreadsheet here that we use in a bond boot camp that before the pandemic we would do a CDAC at least once a year. And it's a spreadsheet where we try to say anyone can understand yield. You don't have to do the calculus or anything else. If you understand what price is and what yield is and what duration is and convexity is, you'll see how they're all related. But for the point of this example, we're going to take a $1 million par amount on a 5-year treasury, and we're just going to take that 5-year treasury from August 2017, and it's a new issue, so its coupon is a 170 and its yield is a 170, and so the price is par. And you're going to understand in a second why is the price par if the coupon rate and the yield are the same. But let's just map that out. So what we're going to do here is the Treasury pays coupon payments semi-annually. So this times 0 is the negative amount. We wrote a check for $1 million for this bond, and now we're going to have 10 semi-annual periods. And on every one of those semi-annual periods, starting with the first 6 months one, they're going to write us a check for $8,500. And then on the final, at the maturity date of the bond, they're going to give us our last $8,500 and our $1 million back. Now, we could just sum up all those amounts and we'd end up with $1,085,000. But we don't sum all those amounts up because those amounts occur at different points in the future. Much like if we were to take a trip and we had $100, 100 euros, and 100 yen, and if someone asked us how much money we had, we'd never say we have 300 generic monetary units. We would convert them all to the same currency. Well, all interest rates are, in this case, our yield of 170 on this yield curve here. All yields are temporal exchange rates. They allow us to move money through time. So when we take money in the present and move it to the future, that's called compounding. And relating back to our definition on the previous slide, when we take cash flows in the future and bring them back to the present, it's called discounting. And the yield curve tells us how we should discount those future cash flows and talk about them in the present value. What are they worth to us in the present? And the way that we do that is we take each one of these cash flows here, and we discount it by the yield. And then we do that for each one of them. And notice that as we move through time and we get further out, that same fixed coupon amount, fixed income means fixed coupon, of $8,500, when we talk about what that's worth to us in the present, that dollar amount in the future, that nominal dollar amount in the future in the cash flow column is worth less to us in terms of the present. So the first $8,500 is worth $8,428 and some change. And that last $8,500, the second to last one that is, in the 9th semi-annual period, is only worth $7,876 and some change to us. Now that we've converted all these nominal future cash flows to what they mean to us in the present, notice that the way that we did that is that we took each of these cash flows and we divided it by 1 plus the yield raised to the semi-annual power. And if you want to see more in the details on this, please look up the Excelling at Bond Bootcamp presentation, and you can get that spreadsheet from CDAC for this presentation as well. But the calculation translates all those future nominal cash flow amounts back to the present with that simple little calculation where you're just dividing each of these nominal cash flows by 1 plus the yield divided by the frequency raised to the semi-annual period. Now, that's it. That's all you're doing. And so we sum them all up, we get what they're worth to us in the present. And when we sum all those cash flows up, they are worth $1 million. Now, this is why we just love ratios in the bond market. And all price is price is just a ratio. It is the sum of the present value of all the future cash flows in the numerator divided by the par amount that we're buying in the denominator. And when those two things are equal, since the sum of all the future cash flows on this bond is $1 million, and we're buying $1 million, the ratio is 1, and it's a percent. And we don't say that. We just do par. We mean 100. The price of the bond is par, because price in the end is just a ratio. But notice, here's the key, and the point for this presentation on return is that if we bought this bond back in August of 2017, and let's say it's the only bond in the portfolio, and someone asks us, well, what are we earning in the portfolio, Kevin? I would say we're earning a 170. In fact, every time we get one of these checks sent to us and deposited into our bank, the amount is $8,500, but the return that we're earning is a 170. And that's because when we bought all these future cash flows here, and we paid $1 million for them back in August of 2017, and let's say we moved to that 5th semi-annual period, and they deposited a check in our bank account for $8,500. Well, all the way back on August 31st, 2017, the portion of that $1 million check that we wrote to buy all this future cash flow streams, the portion that was allocated to this $8,500 was only $8,147.78. And the rate of return that relates the amount of money we risked to the amount of money we're fixing to gain is a 170 for this example here. And that's the case for every single one of these cash flows all the way to the end when we get our principal back and our final cash flow statement. Now notice, you're earning a 170 on every one of these. Every time you get an $8,500 coupon payment, the rate that relates how much of that original amount that was risked, that you wrote the check for when you wrote that $1 million check, to what you're actually gaining and what you're actually being paid in every one of these periods is the original yield to maturity or yield to worst. In fact, it's even better than that. In an environment where you have an upward sloping yield curve, and I started this presentation off after I said that my definition of risk and my definition of return, I said that risk and return are related. You don't get more of one without the other. And you can see that here. As you move out the yield curve, the duration on each one of those treasuries and their maturities, the duration increases as you move down further out in time and maturity. But notice what's happening here. Through standard convention, beyond the scope of this talk, we discount every one of these cash flows by the rate that we would associate with the last cash flow. It's the closest thing an investor can get to a free lunch. In fact, if we were to leave the calculation the way it should be, where each cash flow is discounted by the rate that's associated with that cash flow's maturity, which I've done here, I've done a maturity match discount rates, then the price of the bond actually, when we summed all that up, should be slightly above par in this case, par spot 042. But we don't do that because we actually discount all the cash flows by this 170, not the ones that are shorter than it, because the yield curve is showing us that, well, only the 5-year should be discounted by 170. But through the convention of yield, where we discount each cash flow by the yield associated with the longest maturity of the bond, we end up with a cash flow stream in the present value, where we know that every time we receive one of those cash flow payments, we have earned the original yield to maturity. And it never assumes, there's no assumption in here when we do this, that any of those cash flows ever needed to be reinvested. So in that last slide, we spent a lot of time going through the spreadsheet from the bond boot camp on mapping out the cash flows and looking at how yield was calculated and understanding that each time we receive one of those cash flow statements, payments in the future, we're earning the yield to maturity. And matter of fact, the title of the article that I first started this off with from the Journal of Economics and Finance Education is appropriately titled, Yield to Maturity is Always Received as Promised, of course, barring a default. And the point to note is that the people who make the argument that yield assumes that you have to reinvest the coupons to earn it are confusing yield to maturity, which is just as the Finance and Economics Dictionary pointed out, that discount rate, which when applied to all the future cash flows and brings them back to the present, equals the price of the bond, is different than realized compound yield, which is more in line with total return. If you wanted to have all those cash flow equal at the end of the 5 years a 170 as a lump sum amount at the end of the 5 years, then of course you would need to reinvest them at the 170. But that is earning a 170 on top of what you would have earned by the fact that you spent $1 million to get those cash flows in the first place. Because every time you get one of those cash flows, you have earned that yield to maturity. And as they point out here, by definition, yield to maturity received from holding a bond is independent of how coupon payments are allocated, as long as they are paid on time as contracted. Now let's turn to gain losses and how that affects our understanding of return. Now what I'm going to use here is I'm going to use another part of the strategy toolkit to demonstrate one of our basic understandings of bonds and calculating gains and losses. And that evolves around the strategy that most public funds have in their investment policy, not for speculation. And so they tend to hold the bond to maturity, barring a credit event where they need to evaluate selling it or some rebalancing opportunity. So in this example here, I'm going to take a bond that we bought in August 2019, a 5-year treasury. It has a coupon of a 139 and a yield of 139. And we're going to look at a hypothetical rate move of up 100 basis points. Now, many of you would look at this and go, well, of the two scenarios where rates either rise 100 basis points instantaneously right after I buy the bond, or rates fall 100 basis points instantaneously right after I buy the bond, you would prefer the scenario where the rates fell and the price of your bond increased. But if you are in agreement that you have a preference for income over price gains, that you want to earn continually more income in the portfolio, not less, that you hold bonds to maturity, that it's not for speculation, you should actually have a preference, barring credit events, just for rate moves, where you consistently have a loss in the portfolio. More on that later. The point here is, no matter which scenario happens, the bond is going to end up maturing at par. So let's look at this scenario here. So rates rise 100 basis points. We pay par for the bond, and then rates rise 100 basis points instantaneously, and then instantaneously, the price of the bond drops to 95.31. Well, many of you look at that and go, well, I don't want that to happen. The other scenario, where rates fall 100 basis points instantaneously right after we buy the bond at par, we'd have a gain of 104.95. But no matter which scenario it is, as we move through time and the bond moves towards maturity, regardless of which one of those worlds we occupy, and barring a credit event, the bond's going to mature at par. So it won't matter. And it won't even matter how rates change through the course of owning this bond. Now, the last slide looked at the change in the market value of the bond instantaneously after we bought it and held rates constant under two scenarios. It either rose 100 basis points or declined 100 basis points, and we bought the bond at par. Let's say we change that up a little bit, and we're going to buy a 5-year Treasury in December of 2015. It has a coupon of a 150. We're going to buy it at a 98.76, so we're going to have a yield of a 176. And then we want to understand, well, if rates change randomly throughout the life of the bond, and I have this scenario here, so I say I allow rates to either go up 150 or down 150 basis points, and then so the spreadsheet fills in random rate changes here and gives us our new required rate of return or yield or discount rate on the bond. It won't matter about what the book value is, because whether we calculate the gain loss using the current market value minus our book value, or if the gain loss is just the market value right now minus the market value from the previous period, which is this red line, it won't matter which one, they all end up at par. So regardless of how you calculate gain loss, you're going to always end up at par, and regardless of how rates change and whether you bought it at a discount or a premium or you bought it at par, barring a credit event, you're going to end up back at par. And since you don't have the intention, if you're not a trader and you're an investor, of selling the bond before maturity to profit from a price gain because you're focused on income, how all this changes through time will be irrelevant from the standpoint of a gain loss. Now, this presupposes, of course, that thinking back all the way to the suitability benchmark graph and those top 3 sections, that we've done the historical analysis, the liquidity analysis on the inflows and outflows in our portfolio, so we can be reasonably assured that we're never going to have a situation where we are likely to have to sell a bond to pay an obligation. And if that's the case, then how the gain loss on that bond moves through time, of course we'll expect it. That's the language in our investment policy when it says that we're to earn a market rate of return through budgetary and economic cycles. When you are asked, why do we have a loss in the portfolio? Because our investment policy mandates it. Investment practice is following investment policy. And matter of fact, Mr. Citizen, council member, or board member, if we had our preference, barring a credit event, we would always prefer to see losses in the portfolio because that's a direct benefit to our constituents. Now, I know that a direct benefit to our constituents because we always prefer losses is counterintuitive, but even if we have a scenario unlike the last one where the changes are random and we just say we buy this same bond in December 2015 at a slight discount, we're earning 176, and then after we buy it, rates rise 50 basis points here, it won't matter how we calculate it, whether it's the market value minus the current book value or the change in market value from one time period to the next, because they will all in the end will end up with prices at par because bonds mature at par. So before we move out of the gain losses, I want to just use one quick graph to demonstrate why you should, if you're a public fund, general fund, and you're income oriented, and it's not for speculation, and you're focused on safety, liquidity, and income, and earning a market rate of return through budgetary and economic cycles, that you should prefer losses in the portfolio over gains. So let's look at a 5-year treasury that I put together back in early February. And this treasury was issued close to par, because this graph, this axis here, the right axis is the price, and then the second right axis is the yield on the 5-year treasury. And what happened to it? So we buy it at par. Well, the price starts to go up, but it only goes up because yields are declining. So this is the yield on the 5-year treasury, and yields start to go down. Now, having a gain in this particular bond, I guess, is a good thing if you like the positive nature of having an unrealized gain on your books, but it's actually a negative for the entire portfolio. Unless you just spent all your money and you had no more money to reinvest, then I guess it wouldn't matter to you. But if you're like most public funds and you're in the market at least once or twice a month, and you're going to be that way over the future, every new dollar after you bought this one is being invested in lower, 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 and lower rates, meaning it's earning less and less. That's why you have a gain. A gain is only achieved in the portfolio because those bonds couldn't be bought where you bought them, and you're earning above market returns on them. Well, my guess is that the cost of providing the goods and services at your entity isn't tied to the general level of interest rates in the bond market. In fact, it probably continually rises. And to the extent that the income from the portfolio could be used at all to offset administrative costs and help out the ultimate stakeholders, the citizens in any way, you'd prefer to be earning more income rather than less. And the only way you can earn more income rather than less over time is to have interest rates rise, which means the bonds that you've bought in the past will have losses. And in fact, when that citizen or council member or board member asks you about the gains and losses, you should mention your preference for losses and that the reason you have losses is in fact that the language in your investment policy mandates it, that you're mandated to earn a market rate of return through budgetary and economic cycles, an explicit recognition that there will be gains and losses in the portfolio. So now we have discussed three different facets of the return on the portfolio, where return, remember, is just a ratio that relates how much money was gained or earned given how much money was risked. In the first one, we talked about forecasting. When it comes to the return on the portfolio, and the John Q. Citizen asked you, why are we not earning X or why are we earning below a certain rate? It involves a certain sense of an understanding of what the role of the portfolio is in return of the portfolio, and that's just to earn a market rate of return through budgetary and economic cycles. And in fact, even if you could forecast rates and you knew where they were going to be, probably wouldn't be at the entity to begin with, and that no one really knows, including the experts. And we saw some examples of that. And that the nature of interest rate changes and people getting it right is really nothing more than random chance. And then we talked about the different types of returns. There's book return or book yield and total return, and the two different assumptions. Total return is implicitly in the equation. The user of that is indifferent between the source of return being a price gain or income, and it's only known after the fact. Book yield is always earned as promised, known in advance, and can easily be used in the budgeting process. And then we looked at gains and losses, where a gain is just the difference between the market value and what your current book value on the bond is, and how all the bonds, borrowing, selling them before maturity, will all mature at par. And that you should really have a preference for losses in the portfolio, given that you're income oriented and that you want interest rates to continually rise. And the only trade-off for rates rising is that bonds that exist in the portfolio will have losses in them. This will continually provide the citizens and the ultimate beneficiaries of the income in the portfolio increasing income through rising rates, which will only be achieved by having losses in the portfolio. Now, when we talk about the return on the portfolio, what should we compare it to? Well, what I've come up with, the term I like to use, is weighted equivalent benchmarks. And so let's jump into that right now. The common industry practice in comparing the return on the portfolio, whether that's book yield or total return, versus some benchmark, is to use fixed income indices. Now, in my larger presentation on understanding benchmarks concepts, which can be viewed from the CDAC website, I go into much greater detail, but I want to list one thing out here. A fixed income index is just a collection of bonds that are based on a set of rules. Those rules usually involve that the maturity has to be 1 year or greater, or 1 to 5 years, that the outstanding issue size has to be 250 million and other things. And so they take those rules, they apply the rules to the outstanding bonds in the market, and then all the bonds that satisfy those rules get included into the index. And then they calculate either the book yield or the total return on that index and then compare it to the return on the portfolio. The problem with that, when you use a fixed income index that is by its nature rule-based, and take that collection of bonds in that fixed income index and compare it to the portfolio, it's apples and oranges for the most part. And the two main problems that I'll summarize here are known as the bums problem and the duration problem. So a fixed income index is different than an equity index. An equity index is ownership, equity. Fixed income index is debt, liabilities. And when you take those rules and you apply it to the outstanding bonds in the market, the issuers that will make up the greatest weight in the index and therefore influence all its statistics and its calculations and thus its return, duration, coupon, credit rating will be those that have borrowed the most money. It's known as the bums problem. So you're allowing the bums to determine how your portfolio return should look versus who borrowed the most money. And the second problem is the duration problem. And that's a little more technical, but the duration problem is this: when issuers of debt have a different goal than those like public fund general funds who are lending them money. Issuers of debt are looking to lower their cost of capital. So when they, for example, Apple decides what bonds they're going to issue, they're going to issue them in amounts and in maturities that lower their cost of capital, not increase your portfolio yield. Not what's best for you, what's best for them. In fact, that's going to be the case for all the issuers of debt whose bonds will have satisfied the rules to make up the collection of bonds that will be in the fixed income index. So the duration on the index is what in aggregate was optimal for the issuers of debt and not for the lenders of the money. Now, this is known as the deadbeats problem, and I go into more detail, as I said, into the benchmarks core concepts presentation. But in general, what it means, and more technically, is that fixed income indices really probably aren't a good benchmark, especially when we come to return, for comparing to the return on the portfolio, where your interest rate risk and return preferences may be different than the collection of people's bonds that made up all the bonds that got included into the index. So if the return that's calculated, whether it's book yield or total return, really isn't going to work from a fixed income index, that collection of bonds that's rule-based, where those who have borrowed the most money are going to make up the biggest weight, and the duration from the index, even if the maturities are what we like, isn't going to be the duration that we'd pick. In other words, a fixed income index isn't rooted in our own risk-reward preferences, then what would work? Well, to set this up and then to set us up to moving to the live session where we're going to look at how this would work out in practice on a few examples, there's a wonderful book called The Quantitative Management of Bond Portfolios by Bruce Phelps and his colleagues. And in it, he makes out a couple of interesting points. The first one is that investors who are predominantly concerned with book yield and risk-adjusted book returns can benefit from, of course, performance benchmarks that also use book accounting. And for our purposes, what does that mean? Well, the reason a fixed income index that's rule-based doesn't work and resets every month is that it isn't equivalent and isn't weighted to the amounts of bonds we buy and to the timing of those purchases, because no two investors, as Bruce Phelps points out here, will likely have the same book benchmark even if their underlying index is the same. By its very nature, a book benchmark must be customized for each investor to allow him or her to input their historical vector of cash inflows and outflows. That historical vector will be something we will use in the live session in Excel in a few examples to show how we can answer the question. We have the return on the portfolio, but when someone asks, how are we doing? I think there's three potential answers to that, and we're going to look at how you can, using Excel, and using your access to the internet, and using your own portfolio information, come up with that answer. Because what we want to look at and what we want to realize is that book return, which is, this is a graph from that same book, is very consistent. That's because book return or book yield is always earned as promised, barring default. Total return, which is this line that's all over the place, and all over the place because it takes into consideration something that is not equally meaningful to public fund general funds, and that's the movement in the price and the numerator of that bond, isn't good for budgeting, is not known in advance, and doesn't provide a lot of value to the public fund portfolio manager. Now we're going to be done here, and I look forward to talking with you and showing you how you can construct your own weighted equivalent bond benchmark and how that will help you answer, how can I think about the return that I'm earning on my portfolio? Thank you.